All right. Happy Friday, everybody. Just wanted to do our monthly market stats. So hope everybody's having a good month so far. When we do these market stats, so it's October, so we'll look over all the September numbers and see where everything is headed. So when we're looking at, we're on Market Monitor here. If we look at the sales price, so this is all of Charleston, and look at our sales price. So our sales price year over year, so when you see this at 12.9%, so that's compared to September of last year. So if we go to September of last year, we were at 310, and now we're at 350. So basically the median price has gone from 310 to 350 in a year, which is 12.9%. Now, does everybody remember back in probably about, I think it was June, what this number was? I think we were around 19 or 20%, right? So there was a bigger jump year over year this summer than there is right now. And that's because we started at a low spot. You see, we're at 287, and we had that really strong price increase into a couple future months here. So from that aspect, we saw a lot of price growth right in here. So the price growth here was reflected in what we've been dealing with the last couple of months. Now look at what's happening the last few months here is that we've been fairly flat from an aspect of, if we go from essentially, when we look at the last few months. So if we go from where we were here in June, July, August, September. So look at the last 4 months. We were 355, 340, let's say 350 be the easy, 358, and 350. Right, so we've been fairly flat the last few months. Now that's typically when you look at towards the end of the year, it does flatten out. So, pricing flattens out as you get into those slower months, and then you have a big increase in the spring and summer. But we've been fairly flat, 350-ish the last few months. Now it's still a big increase, 12.9% is still pretty strong. But look at from January, look at the rise from January, consistently higher till June, and now flat for 4 months. So I don't expect, us to be kind of going up from here. It should be flat for the rest of the year. And then towards the beginning of the year and in the spring, it'll probably start to continue higher. But we have tougher year over year comparisons because we had a lot of price growth towards the end of last year. So that's why it's only 12.9%, whereas a few months ago, it was almost 20%. So, just keep an eye on that, but that's kind of interesting. We have really flattened out over the last few months. Price per square foot, again, fairly flat, a little uptick in September, but fairly flat. It reflects that same thing as what we saw in median sales price. So again, a big growth through June and then fairly flat since then. Percent of original list price. So again, I wish Market Monitor could get this fixed, but we're over 100%. We just don't know how far over 100%, but we're still over that 100% line. And unfortunately, the first thing we're going to notice is when it's not 100%, but it could be 101, 102. You really have to break down the numbers individually to see where we're at as a whole. Days on market, we're still sitting at 4. We've been 3 or 4 since March. So if you look at March all the way to September, we're sitting at 3 to 4 months. So remember, median, so we're looking at the median. Median days on market means half the houses are selling in 4 days or less, and half are taking longer than 4 days. So it's not an average, but it just shows you half the houses, as soon as they go on the market, they're getting offers. So if you're dealing with some sellers right now that are sitting in the market for 30, 45 days and they're not getting an offer, well, that's the market telling you you're overpriced. So this is a number to utilize with them, showing them what the norm is. And you can see when you get into the winter months, you can see how much it extends. When you go to the winter months here, like in 2019, which again, pre-COVID, you'd be in the 30s in the winter. So that's not, and even, pre-COVID again, they're in the 30s in the winter of 2020. So that's fairly normal. We'll see what this winter does. You can see the rise in the winter, right? It's higher in the winter months. So we'll see what this winter does. If we go up much, I mean, we're no way we see 30, but you might see a little bit of a rise in the days in the market in the winter, just because that's the traditional seasonality. If we go back further in time, so you can see, even if we go back, even in 13 and 14, which were not bad markets, we were hitting 40 or 50. And in the years of the recession, we were at 60 to 90. So this was the norm in here, is 60 to 90 days. And now we're spoiled with 3 to 4. So we've compressed everything into a really short time frame. But this here is probably more representative of 30 days is probably where we're going to head back at some point. I'm not saying we're going to be at 60 to 90, but 30 days more the norm. Now, I think a big difference from, some of us, me, being in the business for 20 years, and I think there's a couple people on this call that have been in maybe almost as long as I have, but I see Joanne's on here. So what we're going to see is that technology, I think, is going to help us not get back to this point. Because when I started in the business, it was really me kind of sifting through houses for sale and putting buyers in my car and saying, I think you're going to like these 10 houses, these 8 houses. So I can tell you, I showed a lot more properties 20 years ago than I show today. And what's happening is you're having buyers do all their research, online searching, pictures, Google Maps, all the information is readily available. So they're able to rule out houses very quickly or rule in houses very quickly. So they're doing a lot of the homework up front that is going to help us keep this number, what I believe is going to be in this range here, when technology advanced enough where a lot of the buyers can do a lot of the research on their own. So I think what will return to a norm at some point is in this 30, 45 day range. Now, granted, different price properties in different areas will behave differently, but as the market as a whole will be in this 30 to 40 range. So we'll see what this winter brings. Do we go up to 8 to 10 days on the market? Maybe so. Time will tell, but eventually we will return to a more normal market. Months of supply. Again, this is just going back the whole range, but we're back down to 1 month. So if we zoom back in, look what's happening here is that we've gone actually back down. So, we went from, again, still all historically low, 1.11, we were under 1 for a little bit. We rose a bit, but then we went back down. So everybody knows, if you've been in my office, I keep a calendar on my wall of what the daily inventory count is. And, we hit a low in May. So on an inventory standpoint, we hit a low in May. We started to rise back until about when school started. And then we kind of started to fall off a little bit again. And I think this reflection of going down in September is more from a standpoint of we went down in September because of the fact that we had less inventory. The buyers were still around, but we've kind of dropped off in inventory again, which is meaning the months of supply is going down. Now, traditionally, if you look at it, this is not that abnormal for the supply to go down towards the end of the year. So if we look at homes for sale, and again, this is just over the past 3 years, you can see we kind of have crested over and headed back down. Now, when I looked this morning, I think it's like 1935 or so. I don't have it in front of me here, but we're under 2,000 again, homes for sale. So if we go back in time, I want everybody to realize you can see the seasonality in homes for sale. So you see every year there's a seasonality trend here. So you can see the rise and the fall. Now, a normal year, we lose about 10% of our inventory from, just for a ballpark, about when school starts to the end of the year, we lose about 10% of our inventory. So that is very normal seasonality. And I think what we're going through right now, it's hard to tell, but I think we're going through we're returning to a more seasonal trend on that standpoint. If we zoom in here a little bit, I wouldn't be surprised if we're losing some of our inventory going into the winter. Now, what do we get down to? We're going to start this year at a lower number than so start of 2021, we're going to start at a lower number than what we started this year at. So this year on my calendar, we were at 2337. So January 1st of this year, if you woke up, there were 2,337 possible homes to go show in Charleston. And right now we're under 2,000. And then from a standpoint of where we're going to be by the end of the year, we're not going to be at 2,337. I can tell you that. We're not going to go up 400 between now and the end of the year. So January 1st of 2022, we're going to start at a lower level than when we started January of 2021. So again, I don't know exactly where Market Monitor pulls this 2484 number from, but on my calendar, when we woke up at the beginning of the year, it was 2337. So where are we going to be at? 1,700, 1,800? I don't know exactly, but it will be lower. The difference will be, and this is a very important difference, even though we'll be lower to start the year, we're going to return to that more seasonal effect that we see, that we start January and we go up on inventory. So that is a normal, if you look at any normal year, we go up on inventory once January comes around. So I feel like we're going to start a lower number, but go up. At the beginning of 2021, we were going down. So January 21 was the high for the year. So 2337 was the high for the year. So we started this year and we've only been going down. That's not normal. So I believe in 2022, we will start January 1st at a lower number, but go higher from there. Now, how much higher? I think there's a lot of factors that come into play there. How much new construction is available? What are interest rates doing? What does the economy look like? Because to have a seller, you got to have a motivated seller who wants to move to and locally or out of town. They've got to have another place to move, which seems to be our logjam right now, is that you can talk to sellers, but if they don't have anywhere to go, they're not going to list their house. So it's very interesting watching this inventory. Now, I believe May of this year, May 18th of this year will be our low on inventory. It was 1,289. I don't think we're going to see that again. So I think we will start the year and go higher from there. Closed sales. So in closed sales here, you can see September, we closed 1,908, which is still a great number. Historically, it's almost at like all-time high outside of COVID, right? But when we look at the drop off, so we closed 2,478 in June, and now we're closing 1,908. Now that's normal seasonality. Look at any other year, look at the normal seasonality. So yes, the market is slowing down, but that is the seasonal trend that we're used to. We just got spoiled with this spring and summer and last spring and summer. So again, this is normal for our market. Now, how far down do we go? You can see in January of last year, we closed 1,443. Do we go back down there? Maybe so. The trend is headed that way. I'd say other than the delay because of COVID here, I think this year looks a lot like last year on closings. So we can expect it to go down from here, but then rebound into the new year, into the spring and summer. And you can see, doesn't matter what year, let's go to a non-COVID year. Look at the ramp up, right? So we had in 17, in January, we closed 1,033. In June, we closed 2,001. We basically doubled the sales from January to June, but it's that way almost every year. It's basically your low month is January, February, your high month is June, maybe July, and those are usually double the low on closings. Well, the low on closings is January and February because that's when the contracts are written for Thanksgiving, Christmas, New Year. So this is very return to normal seasonality, just at a higher level. New listings. So what's very interesting is that, when I was looking at this the other day, this is one of those charts that if you didn't know what was happening in the outside world with COVID, you would notice no difference in this market. How does this look any different than any of these years, right? It's very similar to other years, and you don't really see much of a difference. So it's that new listing count, and you can see from July, we listed 2,610, 2,353, down to 2,173. We're going in that seasonal trend, right? October will probably be lower. You know, we head that way. Now, what's one interesting thing will be is that you can see some years, big drop off from August to September, like even in here, August to September. See this big drop off? That's because of school, right? So, you know, the start of school, you know, creates people not to want to list their house. But then look at October sometimes. October sometimes has a big bump up from September. I don't know what's going to happen this October. I mean, we're 8 days into it. We'll see if there's a bump up or if it's still that trend down. But when you get to November and December, look at that drop off, right? So every November, December, there's a massive drop off on listings. So again, take your time the next, you know, 90 days between now and the end of the year. This is a great time to find out who's going to be listing here, right? Look at the jump, you know, December 1100, and then 1765, 1972, and then look at the peak. So the peak in 16 was March. Look at the peak in 17, March, peak in 18, March. You see a trend? So what you're going to see is those peak listing months are going to be early spring. So, you know, January, February, March, April, May, when you have those months, those are people that right now are considering moving. So you have to use between now and the end of the year to make a good list and keep in touch with these people that all of a sudden when the new year count, I mean, look at that jump, the fall off and the jump is always, and even, you know, we felt that last year, right? We felt that big drop off and then the big jump. So it's going to happen again this coming year. We're going to have that fall off and maybe we go down to 1,500 homes listed in December, but then it's going to come right back up. So, but it's very interesting. The new listing, you would really not be able to tell that was something happening in the outside world. So pending sales. So again, we peaked on pending sales in March with 2,373. Now, I'll also preface the pending sales with, there are so many homes that have sold off the market this year that this might be a little bit of data that's not readily available because we had so many closed, not even listed in MLS. But you can see the peaks were very similar in 2020 and 2021. And we had a fall off, you know, April to May to June sort of falling off. But if we zoom in, let's zoom in a little bit. So if we zoom in, look how flat the last few months have been. So, you know, starting in June, we had 2090, 2057, 2078, 2047. That's a very flat market. So it's interesting. It's more of a flat period than what we've seen here the last more traditional. You can see more traditional years, it really drops off. You know, once you get to September, there's a big drop off. But we haven't experienced that this year. So that shows how many pent-up demand contracts are out there. Now, one interesting thing, I'm just checking the chat real quick. Joanne stole my thunder. So if you go to new construction, so here's the new construction, right? So when we look at new construction, you know, we have been sitting around, you know, we're in that 450 range, plus or minus. But look at June. So here's, you remember how flat everything was? Look at June to July to August. It's actually gone up when traditionally this time of year it should be going down. So that shows that a lot of the new construction contracts, and maybe it's these builders finally putting them in MLS. I don't have all the reasons why, you know, this number is up, but I think what's happening is all construction types, a lot of this is being propped up and leveled out by the new construction. And you know, this happened back, you know, pre-recession, is that it's taking a lot longer to build houses these days. You know, I wrote a contract in November of 2020 in Liberty Hill, new construction, 2020, November. They're telling him his house isn't going to be done until summer of 2022. So what's happening is the length of time being stretched out because of supply chain issues and development issues. It's being stretched out such that these are going to sit pending as new construction for a lot longer. Because think about it, if they put this in MLS in November of 2020, my one buyer would have been one of these pending sales from about here all the way through the summer of 2022. So that those pending sale new constructions are sitting on the books a lot longer. And that's why I think we're seeing this flattening out. Now, again, that also shows there's a lot of pent-up demand out there that's being unleashed on new construction and resales if we have this many pending for this time of year. Because go back to 2019, we only had 1,200. If you go back to 2018, we had 1,100. So that time of year, we've only had 11 or 1,200 on contract. We're almost double that. So that's pretty impressive that we have that many under contract. Now, we're about the same as last year. So 2020 and 2020. And then this year we have 2047 and 2021. So that's up just a little bit. So fairly flat compared to last year. We'll watch what happens in November, December and see how much of a drop off. Yes, we're going to have a drop off. How much we have, maybe we settle down about 1,600 like we did last year. So it's very interesting to kind of watch that trend, but obviously a buildup with 2020 and 2021 higher than the rest, but pretty consistent growth coming out of the recession, flat, let's say, for a few years, and then obviously an upward trend, but we are higher on pending contracts than we were pre-recession at this point. Dollar volume. So here's the dollar volume, and we'll zoom in here a little bit again. So we finally didn't break $1 billion. So we're at 885 million essentially. But look, we're actually 3.2% lower than a year ago. So last September, we were at 914 million. So we actually closed lower volume this year than we did last year. So you're going to start to see some of these year-over-year trends become very, very challenging to beat. So again, I would have never complained about 885 million, because if you look back in time, 885 million is still higher than anything historical by a good margin pre-COVID. It's higher than anything. Now, again, it's not $1 billion, so it's all relative reference that we are lower than we were. So you do see seasonal trends on volume too. You can see the rise, the fall into the winter. So where do we settle back down? We'll probably settle back down, about where we were here, 650 million. Now, where do we go next year? You can see we broke $1 billion once in 2020, just in July. But then this year we broke it in March, April, May, June, July, and August. So we did it for 6 straight months, and we finally dipped below last month. I don't think we're going to be at $1 billion in October. We might get close because October is usually a higher closing month. But from an aspect of, if we can kind of hit towards $1 billion next year, I think that might be a success. I think this is going to be kind of a cap in volume for a little while of the most that we can possibly do. And again, you're going to see the new construction here on volume. We had a drop off in September, but you'll see some of those pending contracts start to get finalized and closed. And I mean, builders are having challenges getting houses closed quickly. What might have been a 4-month build time might be 6 months now. So everything's been delayed and stretched out. So it is affecting the numbers as a whole. But you can see historically, where the new construction was pre-recession, post-recession, almost nothing, steady for a few years. But we are definitely catching up on, we're getting caught up into right now. The challenge is that a lot of these developments, are behind the curve, meaning we need more new construction in the area, but you can't just flip the switch and start brand new development. So it'll be interesting to watch what's happening on that trend at this point. Shows depending. So, I mean, we're still sitting here about 10 showing. So this is also another good gauge as a listing agent. If you've had more than 10 showings, that's the market saying, hey, you've had enough feedback that people are saying, well, this house is probably overpriced compared to what other active listings are out there. Now, again, it depends on price point and everything, but about 10 showings is a lot of feedback to get of, is this going to work or is it not going to work at this price? Shows per listing. Again, I don't know what happened to showing time data, back here. Zillow just acquired showing time. I don't know how Market Monitor is related to them, from a standpoint of pulling data. I don't know what happened pre-COVID on all this data here. It just all of a sudden disappeared. But, compared, we're finally getting to year-over-year numbers here. So we're 23% more showings per listing than we were a year ago. So activity is still good. It's still very strong. But you can definitely feel that seasonal influence happening to all of us right now. But don't despair. This happens every year. Even if your business is a little slower, there are so many things you can do to prepare for that rise next year. And a big thing to understand is you cannot sleep on what's going to happen, next year, because if we look at new listings, again, this is so important to talk about, but your new listing rise is those first few months of the year. So if you're not ready to go with these prospects that you're getting now, people don't wake up January 1st and decide to sell their house. They pull the trigger maybe, but they've decided back in the fourth quarter of last year that if they were considering selling their house. So, take those listing appointments with a grain of salt right now. Is like, you can go on the listing appointment. They might not be ready to go in October, November, December, but that's the sign that by the time we roll the calendar in the new year, they're going to be part of this group right here that hits that listing. And then here's our tail off right now. So, you have to work this fourth quarter with a declining listing inventory to be able to be prepared for the first quarter of next year. And again, maybe COVID threw out a lot of seasonality, and but we are returning to what we are used to seeing in this market. And I think going forward, yes, it's still a seller's market. Don't get me wrong. When you have 1 month of supply, there's no way that there's still an imbalance of too many buyers for the number of sellers out there. So this is, again, the key number we need to watch moving forward is that can we get off this one, because we've been on here for a while, and essentially, this drop off that we saw here, and I mean, even in July of 2019, the summer, we were about 4.2 months. Now everybody uses 6 months as a demarcation between a buyer's and seller's market. I would say in the middle of 19 and middle of 18, 4 months seemed like a fairly normal market to me. Buyers could look at a house, go look at it again, make up their mind, negotiate, ask for repairs, rely on an appraisal. So this is kind of where I think the market would get back to a healthy level, as if we can get back to about 4 months of inventory. The question is, and I know I've said this before, but the months of supply, if I'm going to look at any of these charts to know the health of the market and what's happening in the world, it's months of supply. So at 1 month of supply, how long is it going to take us to get back to 4 months? Well, it took us from basically we broke the 4 month in October of 2019, went through, the shutdown of COVID and all that. So it took us from basically, let's say the fall of 2019, and then we broke down to one, maybe the low, let's say the spring. So 18 months to get down here. How long does it take to get back? I don't think the rise is probably as quick as the fall. So, we might take 2 to 3 years to get back to 4 months from where we're at today. So, I mean, you're looking at being in a seller's market, unless something drastically changes with the economy, interest rates, something else happens, that effect of trying to build, new construction, again, they can't turn on a dime. And, we have supply chain issues still. I mean, there's 100 ships sitting off the West Coast trying to unload. It's like we have all types of, issues with trying to get the supply chain back in order. And I think that's a couple of years from getting in order. So, again, I think we're in a seller's market, all of next year and probably the following year. Terry had a question: do you anticipate changes in capital gains, and how and will they affect the sellers? So the verdict's still out there on what they're going to do. The proposal that's on the table that's probably the most talked about is changing the capital gains rate from 20 on the federal IRS from 20% to 25%. So keep in mind that's a 5% increase from probably most of the people that we're dealing with that would have capital gains on investment properties. Now you also have to keep in mind, you still have the Obamacare that's 3.8% plus your state, which I think long-term on the state, don't quote me, but I think it's about 4.4%. So when I look at, we're going from about 28.2%. Let's take, South Carolina, we're going from about 28.2% for most people on capital gains on investment properties to about 33.2%. Now, again, there's no law being voted on yet, but it's coming. I don't see how it's not going to change. So, if somebody has $100,000 capital gain, that's $5,000 extra in taxes. So it's something to keep in mind. And then Terry had a question about personal property. So personal property, if it's your primary residence, if you've lived in it 2 of the previous 5 years, then it's a $250,000 exclusion on the gain for a single person, $500,000 for a married couple. And you can only do that once every 2 years. So on your primary residence only. So second homes, it doesn't apply. So second homes, that's an investment property. So that entire gain would be taxed. Now, for those of you, if you work high-end sellers, with this run-up that we've had in the market and prices, a lot of those people are going to be exceeding the $250,000 exclusion for single and $500,000 for married. So, if you had somebody had a $2 million house that's now worth $3 million, and they bought it 10 years ago for $1 million, they've got a $2 million gain, of which they can only exclude $500,000. So they're going to be, and this is where you need to pass it on to their accountant. They're going to be paying a pretty big penny on that capital gain, because primary residence, you still could be paying capital gains taxes on that. So these are all the dynamics that are going to happen here in the next few years, is that if they go up on interest rates, and Joanne's kind of leading me right into this. So when interest rates, it's not really probably an if at this point, when interest rates go up, it depends on how far they go up. But what's going to happen is that, and again, most of us were in this business, right? In here, I closed a buyer in 18 at 5% on a 30-year fixed. So it was 5% right here. So now we've been dealing with 3 and under for quite some time now. So, but 5% was not that long ago. So if we do go up to between 4 and 5%, what is that going to do? Well, it's going to have a huge impact on people's purchasing power, right? And just for example, it's like my low. So here I closed somebody at 5%. I closed somebody in the past year at 2.5% on a 30-year fix. So it was half, right? So if we go from 2.5 back up to 5%, that same house would cost an interest twice the payment. So do you think that person is going to be willing to pay a lot more money for that house on top of twice in interest? So that's going to slow things down from the demand side. And it's all based on affordability. People buy houses off of payments. So it's going to slow down on affordability. And what's going to happen is that it's also going to affect the sellers. Because the seller's like, wait a second, I'm locked in at, let's just take 3%. I'm locked in at 3% on my house. Rates are 4.5. Why am I going to go pay 50% more in interest for an equivalent house, right? So if they make a lateral move in house price, that's 50% more they're paying in interest. So if they upsize and they go up in price, they could be paying double interest, and they're going to say, you know what? Let's renovate the kitchen. Let's add a bathroom. Let's put on our screen porch. Let's put in a pool. So what they're going to do is your sellers, at the same time, your demand from buyers might slow down because of affordability, your demand of wanting to list as a seller is going to slow down, because the reason why they're not going to move is going to be as much they're not going to leave their rate as not leave their house. So I think that's one thing that we're going to have to deal with going forward. As rates go up, it's going to affect buyers and sellers at the same time, slowing down demand on the buyer side, but also it's going to, unless you're moving, if you're relocating for a job, if it's death, if it's divorce, if it's marriage, it needs to be a very defined reason why you would move, and not just because, oh, I want to buy that house up the street. Because buying that house up the street could cost you on your interest rate quite a bit. So I think the federal government is kind of stuck in this situation where they got to do their best to keep these rates down, because if the rates jump up too much, it's going to really slow down the demand. And it's also going to choke off that supply, because the real estate world in the US has a huge impact on the GDP and the economy, because think about what happens in a transaction. You got movers, you got attorneys, insurance companies, there's so many furniture businesses, there's so many things that go into a sale of a house and a move of a person, that if they slow down the transaction count, it's going to really slow down the GDP for the economy. So I think the federal government's kind of stuck doing their best trying to keep the rates low. And I'm not saying they're going to be able to keep it where it's at, but relatively low, because 5% would be a pretty big shock to buyers who have been looking, and all of a sudden their payment is significantly higher. They're going to pull back. Now, the flip side of this is rent's not cheap right now. So, your choice is you're either a tenant or a homeowner, and you have to pay one of those bills. So a lot of what's going to happen is, what do rents do, and how fast do they go up or settle down or go down, is going to affect the home buyers, because you're either going to pay your monthly rent or a monthly mortgage, and the difference between those two is going to make your decision on which way you're going to go. So it's just things to watch going forward of what we're going to have to pay attention to. But I still think, we have a couple years before we can get back to more of a normal market of buyers and sellers being on more equal footing. So, but this is the number that I will watch very closely. And, as it goes up, we're going to know things will change, because the trend at some point, like what happened in here, once we started that downward movement, it was just down, 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 down. Once we start that upward movement, it might take a couple of years, but that upward movement, when it starts, it's going to continue that direction. So again, if you just look at one number, look at months of supply, that'll tell you a lot of what's going on with our business. So, well, I hope that was useful for everybody. And go out and sell a house or two this weekend, or just enjoy your family, or do what you're doing. But we'll do this again next month. And I'll follow up on all this, but and as always, don't hesitate to reach out to me if you have any questions. So I hope everybody has a great weekend, and let's do a deal soon. Thanks again. Bye.